Hello, and welcome to this episode of the Capital Stewards Podcast. I'm going to cover the impact of the Republican election win on portfolios and long-term tax planning. This is also my usual year-end tax planning tips. The outcome of the election really will heavily influence tax policy, so tax planning and the election results are inextricably linked. As I like to say, tax time is now. It's not in March of next year. Once the year closes out, there's only a few things you can really do to change your taxes for 2024 once we get into 2025. So now that the election is over, we have a slightly clearer view on where things are going on the tax and policy front. It's a good time to talk about year-end planning ideas that everyone should consider. So let's dig in. Let's start with the election. I covered Trump's proposed economic policies in detail in a prior episode. Some of those things are really good. Some of those things are not so good. So I'm not going to dive deeply into taxes, the fiscal deficit, tariffs, all of that stuff again in detail here. I'm going to stick to the things that impact you as you plan for the end of 2024. We can circle back on some of those things as we think about the economic and investment outlook for next year and beyond in a few weeks. My view on the market is that a Trump win was basically already priced in. So the day after, we're seeing a bit of a bump in markets. I would expect the market to shift back towards changing based on earnings and economic data fairly quickly now that the market is over. Trump was ahead in the prediction markets, and we had seen things like yields go up and certain areas of the stock market outperform over the last few weeks. So pretty different scenario than what we saw in 2016. I think the market was largely expecting a Trump win prior to yesterday, and then priced in even more of a Trump victory over the course of the evening. It was less sort of a shock. Trump's win, and more importantly, what appears to be a Republican sweep of Congress and the presidency, likely means an extension of the existing low tax rate environment. Perhaps they're able to push through even lower corporate taxes, but for investors, the most important thing is that the existing low capital gains and income tax rates will likely remain in place over the next 4 years. So the biggest implication is that I don't think there's a rush to realize capital gains or to revisit estate plans. That definitely would have occurred had the election results gone the other way. So I think the real impact of the election is you can likely keep doing what you have been doing for the past 5 or 6 years, assuming that you've been doing really good tax planning. So let's talk about some really good tax planning, year-end planning ideas that you need to think about to reduce taxes and make sure that your financial situation is all squared away as we get to the end of the year. And we'll take these in a couple of buckets. The first bucket is items to think about that are related to retirement accounts. So one of the most powerful tools for reducing your taxable income is contributing to retirement accounts. Remember, retirement account contributions are generally tax deductible. For 2024, the contribution limits for 401k plans have increased, allowing you to set aside more pre-tax dollars. The limit for those under 50 is $23,000. So that's what you can contribute. And if you're over 50, you get that catch-up contribution. That's another $7,500. So that means you can contribute $30,500 into 401k plans. Remember, that's only your contribution. Your employer contributions, if they're matching things, those are on top of those limits. A total of $69,000 can be put into qualified retirement plans on your behalf. So if you own a business or if you have some control over what the employee contribution and employer contribution side of that equation is, make sure you understand how to get the maximum deferral benefit. So $69,000 in total can go in on your behalf. As an employee, you can make that $23,000 contribution if you're under 50 or $30,500 contribution if you're over 50. Similarly, individual retirement accounts, IRAs, another avenue to reduce taxable income. The 2024 contribution limit there is $7,000, and there's an additional $1,000 that you can do if you're over 50 to catch up. So one of the key ways to control your taxable income and minimize that is just to contribute to your own future retirement. So make sure you do that before the end of the year. That's also one of the areas where you can make sort of contributions next year in the IRA space for this year. But you want to make sure you get those 401k plan contributions done prior to year end. If you are in retirement, particularly now if you're 73 or older, you need to make sure that you're taking your retired minimum distributions from your IRAs and 401k plans. There's a pretty hefty penalty that goes with failing to do that. So make sure that you understand what the required minimum distributions are for you and make sure that those are coming out of your IRAs. If you don't need all of that money, you can reinvest it in taxable accounts or do other things with it. There's some great planning opportunities that come with RMDs. So make sure you think about that, but don't get to the end of the year and not having taken your RMD. Roth conversions, kind of the third piece of this retirement account planning bucket. Roth conversions involve moving funds from a traditional IRA or a 401k into a Roth IRA. And you pay the taxes when you make that move, because when you take money out of an IRA or 401k that was tax deferred, now you got to pay the taxes on it. So you pay taxes on the converted amount, but then you enjoy tax-free growth over time, and then you can take out the money to use it whenever you need it later in your life. So it can be particularly advantageous if you expect to be in a higher tax bracket in the future. And even if overall tax rates remain low because we get sort of an extension or a permanence of the Trump tax cuts, your income, especially if you're sort of a professional, is likely to go up over time. And that increases your tax bracket and increases your tax rate. So it's essential to do long-term tax planning and income forecasting with your financial planner and your tax professional to get this right. The other point I always make around Roth conversions is they generally work best over multiple years to spread out the tax impact. So think about Roth conversions as something that you do over a series of time, or a series of Roth conversions, not as like a one-time event where you do a Roth conversion. So as we approach the end of the year, think about whether this is a good year for you potentially to do a Roth conversion. So the second bucket of things I want to talk about are related to healthcare accounts. They're tied often to your health insurance or to your work and the benefits that you get through your employer. The first is flexible spending accounts. If you have an FSA or flexible spending account, if you're going through the benefits process still, these are great things to have. They allow you to set aside pre-tax dollars for medical and dependent care expenses. So it can also be some child care and potentially elder care, parent care thrown in there. But you can use those FSA dollars for those kinds of things, and you don't have to pay taxes on that money as income. There's generally limits, $3,200 for 2024. So if you have, if you expect to have big medical bills by the end of the year, you could still sock some money into an FSA. But the most important thing as we get to the end of the year is FSAs, different than health savings accounts. Flex spending accounts are sort of usually use it or lose it, and a couple $100 generally you can roll from one year to the next, but that depends on your employer's plan. So you want to make sure you don't have a few $1,000 sitting in there that you lose going into next year. So if you have flex spending account money and you don't have lots of medical bills coming up, make sure you use that money before the end of the year. One thing that you can roll over to next year is health savings account contributions. Health savings accounts are a really important and often forgotten tool when we think about long-term tax planning. And the reason for that is that health savings accounts kind of have the trifecta of tax benefits. The contributions are tax deductible, so you can write them off against your income. The money grows tax-free. You don't pay taxes on capital gains and income while they're accruing in the account. And then when you use the account for qualified medical expenses, the withdrawals are tax-free. So it's a no tax account. It's the only thing like it in the world. And I think almost everyone will have some kind of healthcare expenses over the course of their life. And so this is a really good planning idea for most folks. For 2024, the individual contribution amount is $4,300 for individuals, $8,300 for families, with an additional $1,000 catch up for folks that are over 55. That's a lot of tax deferral power. So if you're looking for something to do tax deferrals, don't miss out on this one. Health savings accounts can generally be open. Sometimes you can do them through your employer if you're working somewhere. You can also open them at brokerage firms and things like that. You can talk to a financial planner or an advisor about how health savings accounts work. But you can invest the dollars in there. So if you say, hey, well, I don't have big healthcare expenses now, at some point as you age, you're probably going to have some healthcare expenses. And so you can save that money for a rainy day for down the road when you're older and your healthcare bills go up, and that money gets invested over time in a tax advantaged way. So really important. Think about making health savings account contributions if you're looking for things to control your income. All right, so let's talk about investing in taxable accounts for a minute. So for those of you that have assets that are outside of traditional retirement accounts, one of the first considerations that you need to make sure you think about, and often folks get reminded when these things happen at the end of the year, but they forget about planning for them ahead of time. You need to plan ahead for those year-end capital gains distributions that come out of mutual funds. So if you're investing through traditional mutual funds, you might get those. Sometimes they're called phantom year-end capital gains distributions, or just year-end capital gains distributions. Those occur because throughout the year, mutual funds are selling stocks for a profit or a gain. The capital gains taxes on those investment gains, they have to be paid by taxable investors in the fund. So they distribute those gains to investors in December. And that can increase the total amount of capital gains that you end up taking for the year unexpectedly. Gains are often similar from year to year, so you can plan for them if you look sort of at prior years and see what the distributions were for a particular mutual fund, unless they've said publicly that they're going to change that. You can assume that they will be pretty similar. So as you think about moving into the end of the year, make sure that when you think about your capital gains planning and realizing losses and things like that, that you're planning to get those distributions and you've got a plan to offset those if it's possible. If you're getting capital gains distributions regularly from a fund, it might be worth considering using ETFs instead of mutual funds, especially if that mutual fund is underperforming. In that case, you're paying the taxes, but you're not getting the investment results. So in an ETF, you only pay capital gains taxes on the actual realized gains that you have in the fund. That's one of the main reasons why ETFs are more tax efficient than mutual funds. So if you're getting to capital gains distributions, plan ahead for them. And then if that's happening, also think about, hey, maybe we should do something different like ETFs to try to keep that from happening. Tax loss harvesting. This involves selling investments that are down, right, and realizing those losses. And then you can use those to offset gains that you take at other points in the year. That can help reduce your capital gains tax liability, and then you can use a little bit of that to offset your ordinary income. But really, we use tax loss harvesting to offset capital gains. Tax loss harvesting, it is important to look at the end of the year because we certainly want to make sure that we harvest losses that are available. But really, this is a strategy you need to think about. And if you haven't been doing it throughout the year, you want to make sure that you're actively looking at potential losses and harvesting those throughout the year, because at any point in the year, even a year like 2024, when we've had pretty strong investment gains across the board, there have been points in time where parts of the portfolio may have been down, and you can realize those losses and use those to offset future gains. So it's important that you do really active tax loss harvesting throughout the year. That's something that a professional can help you with. But if you haven't done that, year-end is a good time to make sure that you've harvested losses that are in your portfolio so that you've got them to offset your taxes. All right. The next bucket is controlling your income. This is actually something that a lot of people sort of forget to think about as a tax strategy, to sort of think about, hey, I've got deductions for retirement accounts, and maybe I do some healthcare and insurance things. I definitely want to make sure that I offset capital gains from my investment portfolio. But they forget that maybe I can just control my income and that'll help manage my taxes. You should review your projected taxable income for 2024 and for 2025. If you own a business or if you manage a partnership where you have some control over your personal income, think about accelerating or deferring income. It's especially true if your business income tends to be really high in some years and low in other years. If it's particularly cyclical, or if you just have really kind of banner years and then other years that aren't as good, you might be better off paying out sort of a smooth tax rate rather than an extraordinarily high tax rate in one year and a much lower rate the next year. So that means you might think about either accelerating, your income into 2024 or potentially deferring some of it into 2025, depending on how you need to manage that. But you want to make sure that you're controlling that. This also is a strategy if you have paid alternative minimum taxes, or if you think you might be in a bucket where you're exposed to the alternative minimum tax regime, then controlling your business income can be a way to avoid that. And similarly to controlling the income that you take personally, you want to strategize around your business expenses as you get to the end of the year. So if you're self-employed or if you own a business, you should consider accelerating deductible expenses into the current year or deferring them until next year. So maybe you buy office supplies, equipment, things that you're going to need next year. Maybe you just go ahead and make those purchases now so that you can write them off for tax purposes, or say, hey, I'm okay this year. My income is lower, so I'm going to wait and push some things off into next year. So you want to control those business expenses so that you can control your overall taxable income. And then lastly, I always talk about charitable deductions in this category. And my general thesis around, contributing to charities, I want you to give because you want to be generous, right? So we shouldn't just give because we get tax benefits for it. That's nice. If you're going to give to your church, to the community, to different philanthropic organizations, you definitely want to make sure you're getting all the tax benefits that you can for your contributions. But don't think about charitable contributions as a sort of a tax-led strategy. Think about it as, hey, what do I want to do? What are my goals? How do I want to be generous? And then once I've sort of figured out how I want to give to the community, then kind of think about, okay, what's the best way to optimize that goal from a tax standpoint. Obviously, donations to qualified public charities are tax deductible, so you can give the charities and write that off on your taxes. You also can think about, we've had a pretty big year in the stock market, and so when you give to charities, instead of giving cash, you can give appreciated assets. So you can donate stock out of a brokerage account. Most charities have a way for you to do that. So you just need to talk to your advisor or talk to the charity, whoever their financial manager is. They can often give you the information to donate stock or mutual funds or things like that, and they'll sell it as soon as they get it. But when they sell it, they don't have to pay taxes on those gains. And so if you're thinking about selling particularly stocks this year at a gain, and you're going to make a charitable contribution, you can give them the appreciated assets, avoid paying the capital gain, and still get the tax write-off for the total value that you gave to them. So it's kind of a double whammy on the positive side from a tax standpoint. So think about giving appreciated assets if you're going to do some charitable things at the end of the year. Also, if you're over 70, you might be able to make a qualified charitable distribution from your IRA. And that allows you to donate up to $100,000 directly to a charity. It counts towards your required minimum distribution. So if you're in trouble and saying, hey, I have to take all these required minimum distributions and pay taxes, and I don't really want to do that, maybe you can give some of that money to charity instead of giving it to the government. And if it goes to a qualified charitable organization, it's not included in your taxable income. So think about giving directly out of your IRA. So I would kind of wrap all that charitable conversation up to say, hey, if you're thinking about doing some year-end giving, think about what you want to do, what kind of impact you want to have, and then talk to somebody about what's the best way to do that, because it might not just be writing a check. It might be giving assets, it might be giving out of a retirement account, or doing something different from a tax perspective to help reduce your tax bill for 2024. So think about how you give and do it strategically. And remember, as always, when we talk about tax stuff, this is not an exhaustive checklist, and it's not tax advice you need. Taxes are very personal. They're very different from situation to situation. So it's meant to be a starting point to spur deeper conversation between you and your advisor. So you need to talk to your CPA, talk to your financial planner, talk to the professionals that you work with before you make any decisions about sort of, anything really financial planning related, but certainly things that you think are going to have a direct impact on your taxes. If you want to talk further with us, we're happy to do that. You can go to our website. We'll have a link below in the video and in the podcast, and you can schedule time to talk to me, and I'll be happy to talk about different tax strategies and year-end planning tips with you further. So this concludes our year-end planning tips podcast. We will see you next time on the next episode of the Capital Stewards podcast.